Market View on MoneyFM 89.3.
The last 3 months of the year are shaping up to be exciting ones for Chinese markets, with macro data pointing at a steady recovery for the most part. Investors will also be looking out for how the upcoming U.S. elections might shape things for Greater China. Well, to discuss more, we're joined today on Money FM 89.3 by Mr. Peter Chun, the founder of Silverbear Capital from Hong Kong, to discuss and talk about what he's watching out for in the next 2.5 months. Peter, thank you so much for joining us today on the show. Glad to hear you and your loved ones continue to stay healthy and safe in these times. And welcome back to the show, sir.
Thank you very much.
All right. So again, Peter, when we look at the macroeconomic indicators for China, they have been fairly impressive and consistent for the most part in pointing towards a steady economic recovery. Mind you, we're also about a couple of days away from Monday when China is set to release their third quarter GDP figures. Well, all these indicators, are you taking strength from some of the positive data that's been coming out? And how is this influencing your view for greater Chinese markets?
Well, I mean, the figures kind of is a hybrid mix between the internal indicators whereby how China is doing at the moment, and also I think some of the numbers are contributed by the One Belt One Road strategy, which China is basically pushing a lot. And again, just to remind you, I mean, this One Belt One Road strategy that China has been implementing would benefit a lot of the Chinese companies who actually got involved into infrastructure projects outside China legitimately through China arrangement. And again, this would form part of the numbers that you're seeing today. And again, my view is China is doing whatever it can right now to recover it. I think they're not exactly ahead of the curve, but I think the hedging component, for example, this One Belt One Road strategy, is definitely helping already.
And apart from the One Belt, One Road strategy, it seems that we do know that mainland China is heading towards another plenum to try and plan their next 5-year strategy. Chinese President Xi Jinping did deliver a speech in Shenzhen that hints towards technological innovation being in a major component of this possible strategy. Well, how big a deal is this for China as they try to prepare to craft the next 5-year plan? And does this mean that the Greater Bay Area will play an even more significant role?
And that's a very good question. This 5-year plan, I would probably see this as a China new dual circulation economical strategy, which relies more on the domestic demand to offset external instability, which is a good thing. And also, if you have actually see the evolution of China from 30 years ago, whereby we have been very heavily farming our land to people getting off the farm, going into the city and transform, themselves from being a farmer family type into maybe an fully educated family with gears that would allow them to do other jobs. So after 30, 40 years now, I think what the government had actually identified is you can no longer really push young people to do farming anymore. If not farming, can you go into a factory just like 20 years ago, whereby everybody was in the manufacturing businesses? Probably not anymore. And then what can they do? Well, services. Maybe they can do retail. They can do other stuff. And actually, they have, of course, then identified tech being probably the easiest way to attract young neighbor forces to go into, which will allow the country to move on faster. So I think that's kind of the reason behind the 5-year scheme, to really push the young people and to really increase the GDP of the young people in China, which hopefully form a significant part of the GDP ratio moving forward. So that's why the tech-driven strategy was given.
So how is this influencing your view now on Chinese tech shares if this does provide a bit of a boost, Peter? The conditions seem to be favoring them more than their U.S. counterparts, but does this pretty much make a clear case for Chinese tech versus, say, U.S. tech shares, which seem to be trading at pretty lofty valuations, but also don't really show much signs of slowing down until the last couple of days?
That's a good question as well. We continue to advise people to probably look into the tech share again in China still, not because they are a good buy or they're really a company of what they claim to be worth. But we believe these companies which had attracted enormous amount of capital through the IPOs or so would go into heavy M&As after that, meaning that if a new kid on the block had decided to open up a shop, an IT shop, and they were very clever with disruptive ideas and stuff, grown the company to a certain size, and I would probably think one of these giant guys would probably just use this cash to buy them anyway and consolidate. Win-win situation, of course. But I think these giant tech companies would probably adapt the strategy very similar to the US giants are using right now to keep up their momentum. So I would believe buying the shares at this point of the time, if there's an IPO, would be still okay. I would just think they're just too large to fail at this point, because they will probably adapt the M&A strategy right away after that.
We're still speaking to Mr. Peter Chun, the founder of Silverbear Capital, here on MoneyFM 89.3, and talking about big tech giants. There is one that will be coming online pretty soon, and they're expecting this to be arguably the biggest IPO in history. And we're talking, of course, about Ant Group. Can you share with us your thoughts or your opinion on the upcoming IPO by Ant Group and how big a deal this is for markets both in Hong Kong and in Shanghai?
Well, I mean, again, everybody is kind of focused with their eyes on the Ant right now. It has been a very interesting case since the Alibaba. We got involved as well, of course. Recently, there is a little hiccup 2 days ago, I think 1 day ago, 2 days ago, whereby the stock exchange in Shanghai was investigating into the IPO, posting possible delay of the IPO dates for Ant. Now, just so I can remind all the people here, right now Ant has a unique dual listing strategy with the Shanghai and Hong Kong at the same time. And unlike all the other financial tech companies out there, they actually had refuses institutional cornerstones investors this time, which makes it very unique when it comes to people trying to analyze whether this is a good thing or a bad thing. So to a lot of the retail investors right here in Hong Kong and China, this seems to be a good thing for some reason, because they were afraid that if the institutional guys, the cornerstone guys, took, say, certain amount of shares, that would decrease the chance or the opportunity for them to actually be able to buy or subscribe to the IPO shares that they're trying to subscribe. So I'm seeing some very interesting things about Ant here in Hong Kong and China locally, despite all the positive media news and the momentum that they're creating on the internet or offline already.
Do you think they should be classified more as a financial company or a tech company, or should they just be somewhere in the middle? Like a bit of a hybrid, like a new hybrid monster of some sorts?
Well, I would probably say it's a hybrid, but more clinging on to the financial side. Now, again, are they invulnerable? I can't say that because there is no barrier to enter into the market at the moment. Although, unlike US, China do not have a stringent monopolized policies in China yet. But, I would probably say they're a little bit more clinging onto the financial side, because you can see that a lot of their income are driven actually from providing financial services to the people. Although used, well, put it that way, I think the technology was spun off from the original mother company, and the tech side up to now were not being promoted as 200% destructive, as we can see, but they definitely had the user space, and they definitely had the momentum so far. So I would probably say they're a little bit more on the financial end, Still, yes, there are hybrid. I do honestly believe that as well, but a little bit more on the financial end.
Okay, and finally, Peter, I wanted to ask you also about the upcoming U.S. elections. This is what everybody's talking about, not just in markets, but pretty much the world, just watching out for who might become the next leader of the United States. What are you watching out for in terms of your investment decisions as we approach the November 3 polls?
Actually, yes, we are watching very closely about the elections. Right now, we are started to we're starting to kind of towards the end of the election. So we started again on our entertainment investment again, which most of the investments would allow us to be able to cover China and U.S. market at the same time, because we believed after the election, the China and U.S. relationship, whether which president is going to be on the wheels, is going to probably start repairing the relationship very quickly. I think the relationship had been dragged on to an extent whereby it's hurting both ends already, and I think both ends had already realized that this needs to be harnessed in a way whereby a bandage needs to be put on. Otherwise, you would just bleed to death on both ends anyway.
Mr. Peter Chun, founder of Silverbear Capital from Hong Kong, thank you so much for joining us today on Money FM 89.3 to share with us your outlook and for the Chinese economy and greater Chinese markets as we head into a very busy last quarter of 2020. As always, I wish you and your loved ones continued good health and safety in these times, and we look forward to the next time you're able to join us on the broadcast. Have a great rest of the week, sir.
To listen to more great interviews, download our podcasts at moneyfm893.sg. or download the SPH radio app available on Google Play or the App Store.